Thank you everyone for joining today. Today is Feb 9. We are happy to be sharing about India's budget highlights. We recently saw India but passed the budget, union budget on Feb 1st. There's been a bunch of things, which has been announced. Also somewhat of a confusion, if it's going to be implemented or not. And I'm sure you would have these questions. So I'm excited to bring in a panel today, Mr. Abhishek Batra, Ajay Vaswani, and Naman Malu. They are both I mean, not both, they are all experienced in NRI taxation particularly. And they have been also on the iNRI community for a long time, almost a year now. And so I am personally happy to see them all together today and, sharing about budget and also, what it means for NRIs in a way. So with that, we could start today and then, but also would love to, first go through a round of introductions. So, starting with Abhishek, just share a couple of words about yourself and, about what you do.
Yeah, Hemant, I guess I was missed out something.
Yeah, I just said about introduction. Please feel free
Okay.
to add.
So, hi, hi everyone. I'm Abhishek Batra. I am a practicing CPA in Canada. I have been in Canada for last 2 years, but I have been a chartered accountant for last 25 years, practicing primarily in taxation matters. I hold specialization in indirect taxes as well as direct taxes. I have been working for NRI clients for last 15 years. I am a CPA in USA, Canada, and India, both all three countries, and I practice in all the three countries. So, in case you need any assistance, you can get in touch with me for that. And moreover, we are there on the platform. Ajay, me, and Naman are all on the platform, the Go NRI, and all the services are available through Go NRI. You can log in anytime and get in touch with us. Moving forward, I guess, Ajay, I would request you to introduce it.
Yeah, thank you, Hemant, first of all, having all of us over here on this budget panel. Hi, Abhishek, hi, Naman, and hello, everyone who are joining here today. And on a subject which has mostly been ignored the other way in India, but good that Hemant is organizing these kind of sessions very often to educate the NRI community at large. So my kudos to you and your team, Hemant.
Thank
So
you.
by qualification, I am a chartered accountant, company secretary, a law graduate, and a commerce graduate. And since day one of my career, it's been 13 years now, I handle only and exclusively NRI. So primarily, I don't have even a single resident client. And it's been day in, day out, I have been only speaking to NRI. I travel very aggressively to the Gulf countries, to Singapore and to Hong Kong. And soon this year, we are starting operations in the US, UK also. And of course, NRI taxation is my forte, but major of my time goes into handling the real estate transactions for NRI. So that has been a super thing for me. Over to you, Naman.
Yeah, so thank you, Ajay. Thank you everyone first of all for joining the session, and it's good that people are interested in listening to the budget or the tax prospects in India because India is a growing market, and in the next few years it will be giving some good returns. So about myself, I am a chartered accountant, and I've been practicing taxation for last 7 years, and my core area for dealing is into taxation, and I deal mainly into international cross-border transactions, and mainly now I'm specializing in the litigation sector. So with regard to any notices or any appeals that are going on in the income tax, we look after that. So currently I'm based out in Jaipur, and I'm looking after international taxation, and for last 1.5 years I believe I'm connected with Hemant for NRI taxation, and I think it's a great platform. I keep looking at the group, and the group is also very active in relation to any updates that come in. So looking forward to a great interactive section.
Thank you all. I also want to share about iNRI. I guess probably I didn't mention of it, but iNRI has been a strong community. And moreover, that we provide a platform to for NRIs to interact and essentially manage their India finances. We built investments as the first asset class and now we are also going deeper into cross-border compliance. And proud to have this team together today to share more on budget specifically this evening. So with that, let's get started. Um, so I think first question is obviously, given the audience, what's changing for NRIs? And let's go deeper here. Ajay, you want to take forward?
So yeah, first of all, if you see the first paragraph itself, when the Honorable Finance Minister was presenting upon the budget, the mention was, of course, that the new income tax bill is going to be presented in the Parliament by next week. So this was on the first Feb, and with good probability, so the Union has cleared it, and with good probability is going to be tabled in the Parliament tomorrow. And once it is cleared, Rajya Sabha and Lok Sabha clears the bill. It goes to the President for the assent, and once the assent is there, if it would be made effective. A good probability it is that it will be effective from 1st April. The entire concept of new income tax bill is to rationalize the entire structure of the income tax, make it very easy to understand, easy to read, easy to implement, and further, the comprehensive sections, the paragraphs are being shortened so that it is very easy and it is litigation free. So that is the entire concept. And a few changes were made around. And so first, the major change was that it was said that till 12 lakh there is no income tax in India. So primarily, but that is only for resident. The slab rates are exactly the same for resident and non-resident. Only in addition that is resident get the benefit of the rebate. So otherwise, residents in India pay taxes on different kind of ways. They pay in indirect taxes. There is GST, then there is customs, and there is fuel surcharge. So there are n number of taxes eventually which residents are paying. So they have given a rebate to the resident, and such rebate is not available to non-resident. For non-resident, the taxation slab has been made much easier. So the new regime you see till 4 lakh there is no taxation. Every 4 lakh there is an increase in 5%. So 4 lakh to 8 lakh tax would be 5%, 8 to 12 it is 10%, and so on. So above 24, the tax rate is 30%. This eventually is saving almost a lakh 10,000 rupee worth of taxes eventually. So an individual who was paying taxes more than income more than 24 lakh last year, now he would be saving 1 lakh 10,000 with the effective in the change in the tax rates. So this is about the new regime. So whatever budget comes in has been implemented for financial year 25-26. Right now we are in financial year 24-25. The ITR that would be filed by July 25
Mm,
would be as per the slab rates, which is in the center table. So till 3 lakh there is no taxes. 25-26 onwards, it would be till 4 lakh. So you have to be very cautious in understanding the concept for 24-25 and 25-26.
all right. Anything, Naman, Abhishek, you want to add, like uh, specifically for NRI or other things, which probably will change?
No, as far as the slab rate goes, I believe it's important that he highlighted about the rebate because it has been very much highlighted that till 12 lakhs it's a
Mm,
tax-free income in India, but that's not the case. Plus, the rebate is also not available with regard to when we see the capital gain income. So, and most of the NRIs invest in India for that capital gain income. So that we need to check that the capital gain income is and if they're investing in NRE deposits, then this 4 lakh will also not get exhausted because the NRE deposit income is any which ways exempt. So that we need to check, and now it's more like from last year they have got 1.5 lakhs of more tax-free income under the old regime if they come to new regime, and as far as the new regime goes, they are
mm,
saving 1 lakh more in India on tax. So that's good.
Yeah. One thing which I want to add here is that this is the slab rate applicable on the taxable income. As Naman has rightly pointed out, you have personal exemptions available in under categories of income like for interest and capital gains. There are specific exemptions like long-term capital gains up to 1 lakh is also tax-free in case of mutual fund investments. Interest is also tax-free up to a certain amount for senior citizens. So these are on the taxable income. While determining the taxable income, you can claim individual
mm,
exemptions which are available for the categories of income. One thing which is more important is the fact this is only applicable in relation to income tax which is payable in India. But the income which is there in your country where you're residing, let's say you are in Canada or in US. So these income, whether it is 1 lakh or 2 lakh, has to be added to your income in the respective country while filing your return. And there is no exemption for that. So just keep in mind the exemption is available only for filing of returns in India. Yeah. We can go ahead, Hemant.
Okay. Yeah, thanks for adding the nuances. Okay. So surcharge and cess. Yes.
So, in addition to the tax liability, there is a surcharge and cess which is payable. And so, surcharge is based on the progressive rates of tax. Till 50 lakh of income in India, there is no surcharge. And 50 lakh to 1 crore, it is 10%. Then 1 crore to 2 crore, it is 15%. Then 2 crore to 5 crore, it is 25%. And above 5 crore, it was 37%. Here, the amendment is now the maximum rate they have defined for surcharge is 25%. And surcharge is restricted to 15%, where dividend income is there, or there is a capital gain on
Mhm.
where STT is paid. So basically, on shares and mutual fund, maximum surcharge would be 15%. So whatever is your tax liability, add surcharge to that. Surcharge plus tax, what is the component? Education cess is added further on that, which is 4%.
Yeah, I think this is
Yeah.
quite
So
straightforward.
if I have to
Anything
give
to
you
add?
an example, if I have to give you a
Mhm.
further example, how this works is if it is a long-term capital gain on a sale of a immovable property, so tax rate is 12.5% there. And if you're selling a property which is about 2 crore, there is a 25% surcharge and 4% education cess. So your effective rate goes to 16.25%. That is how it is calculated.
So the surcharge and cess is on the tax liability, not on the gain. Is that right?
Yeah.
Yeah,
Yes.
only on the tax liability, not on the income component.
Got it.
And just to add with regard to the property transaction, so if a person is getting a lower deduction in India, they need to keep in mind that the lower deduction provided is for just the tax amount. The surcharge and cess will still be added on that amount based on the sale consideration.
So this is a very good point, and every day we see that
Mm.
lower deduction is being done, or people getting notice for the short deduction of TDS. Because when you apply for a lower TDS certificate, your 12.5 is reduced further. It is not that surcharge and education cess is also reduced. Effectively, if you are getting a lower TDS certificate for say 3%, so 3% plus surcharge and plus cess is your effective tax liability that you have to pay as a tax deduction at source while paying to the seller. If you are not doing it, down the line, income tax will send you the notice for short deduction of the TDS.
Just to add from the last budget, because we are going near to the return filing season for this year, the last year amendment for with indexation and without indexation is not available to the non-residents. So any non-residents who are selling the property, they will have to pay the tax straightly on the sale minus cost at 12.5%. No indexation benefit available to them. Just for the clarity.
Mm.
So this budget hasn't really changed on anything on the capital gain part, since most of the things were simplified in July 24 budget when it was presented. The finance minister has really not touched any of the points on the structure of the taxes. So it is 12.5 or 20, be it long term, short term, and the classes of the assets have been very simplified and segregated now. So that is the reason there was no touch points on the same this finance budget.
Mm. Got it. Should we move on? Then?
Yeah.
Yes.
Yeah, yeah.
Okay, so updated return. And how does this mean for, let's say, NRI? Like, given sometimes people may not file, right? And what is ITR-U? Please help with that as well.
I think Abhishek, you can take this.
Yeah. ITR-U is nothing but a updated return. As per the income tax law in India, anybody who is required to file the tax return, he has to file it before 31st of July without any late fees and penalties. After 31st July, there is a late fee and penalty, which is applicable till 31st of December. And if you 31st December of that financial of that year is also gone by, like in our case, if you want to file a return for like 31st March 24 now, so you cannot file a return. You have to file an updated return. There's a specific provision which allows you to file updated return after 31st December of the year. And in that case, there is an additional caveat that you pay the late fees, filing fees, and 25% of the additional tax as penalty, one-time penalty for all the taxes which is due. It is applicable only when you are having a case where you have to pay tax. In case you don't have to pay tax and you are not eligible to file tax updated return, which is in case of return of loss, whether it is resulting into reduction of your tax liability or it is resulting into a refund. In all those cases, you cannot change the return or you cannot file the return. If you have not filed the return by 31st December, then you cannot file it. Earlier, this provision was existing only for 2 years. Now it has been extended by 3 years. So it has 2 more years. So 5 years is the total period within which you can file your extended return. This can be quite helpful in cases where we have to file returns of a later period or earlier periods, and we can have to pay the tax. Whatever tax we pay, we can get the adjustment for that in our country where we are residing as a tax credit for that foreign tax credit in that country. So it can be helpful for claiming that foreign tax credit at a later date for the previous years, because there may be an overlap. Like in case of US, you have a financial year ending on December, and where in India you have it at 24 March. Somebody who sold a property in March 24, he may not be eligible. He may be eligible to get the foreign tax credit, but he has not filed a return. So he can file the return now with an updated return and create an evidence for the transaction which he did. So it will be helpful for those where have to avoid any kind of litigation and audit and all those. And it is additional document which is filed with the government authority, which provides you an evidence that the tax has been paid. So there are different slabs depending on the period. Moving on to the next slide, we can show you what are the slabs wherein the penalties change. Up to first year, what there's a different penalty, second year it is a different penalty, third year is a different penalty. Even we can move on to the next slide. Yeah. If we file the return within 2 years, then we have to pay 25% as additional amount. Second to third year, we have to pay 50%. Third to 3 to 4 year, it was 60%, and 4 to 5 years, 70%. These three new slabs, 50, 60, 70, have been introduced in the current year. So in case you have any additional liability of the past and you want to pay tax, then you can pay tax, but you have to pay along with this additional amount so that there is no other further litigation from the Indian government in relation to that amount. So, anything you would like to add, Ajay?
So basically, see, the primary due date to file income tax return in India is 31st July. In case you miss upon the due date of 31st July, there is a concept of belated income tax return where you can file your income tax return till 31st December. So, of course, if you're filing the income tax return after the primary due date and before the 31st December, there is a nominal penalty which is based on your income range. So, either it is 1,000 rupee or 5,000. And second thing is, you cannot carry forward the loss if you're filing a belated return. So, if you file your income tax return before 31st July, whatever loss is there, of course, it will be set it off. But any unobserved loss, you can carry it forward up to even 8 years. However, if you're filing the income tax return after 31st July and before 31st December, you can set off the loss in that relevant assessment year, but you cannot carry forward the loss. Second disadvantage after filing ITR is after the due date is primary due date, you cannot revise your income tax return. So if you have filed your income tax return between 1st August to 31st December, you cannot file for a revised income tax return even if you come across a mistake which is apparent on record. The primary due date and the belated income tax return date is there, but however in government has given you an opportunity. So this is not a very old concept, this was brought in just 2 3 years back. So government says in case you miss upon filing your income tax return wherein your income was taxable and tax was due on that, so the earlier provision was income tax officer would be sending you a notice, assessment was done, and if he sees that there is a income on which tax is not paid, so penalties would go up to even 300% plus interest, of course. So to save you from that part, the government has brought in a concept which was earlier 2 years. Now it has been amended to 4 years, that you can go back for 4 years and file for your income tax return if you find that there is a taxable Indian income. To save upon from the massive penalty, you should utilize this as an opportunity and file your tax return. And good part is you have 4 years of tax records available, which eventually makes you financially disciplined also. So this is the entire concept of ITR-U.
Just to add one more point here is that even if you have a late fee, so let's say for example, although the tax rate which we discussed earlier is 3 lakhs or 4 lakhs. But the thing is that as per the income tax law, still the people who are required to file the return, they have to file the return whenever their income crosses 2.5 lakhs. So if your income crosses 2.5 lakhs, but it is still below 3 or 4 lakhs, you might not be liable to pay any tax, but still there will be a late fee. Correct. So just by this late fee, you cannot file the updated return. If you see in your return that you have a late fee, that will not still allow you to file a updated return. So you need to have some tax, number one, to file the updated return. Number two, as far as the loss is concerned, as rightly mentioned by Mr. Ajay, that loss you cannot carry forward, but it is advisable that even in case of a losses, because now we are seeing that in Indian markets are currently at a lower stage, so many people might be having losses, so they might be thinking that why to file a return in case of a loss and incur additional expense in India. But it is advisable from a legal point of view to always file your return even in case of a loss. Number one, there are two benefits of that. Number one, you can claim that loss in future years. You will get the benefit of that loss, and in future, if you make a profit, which you surely will in India, then in that case, you can set off that loss and save the taxes in future. This is one benefit. Second benefit is that from the income tax point of view, now the income tax is moving to AI. Correct? They are using digital data to send notices to automatic notices to many people, be it non-resident or a resident. So when they see that you have a sale of mutual funds or sale of shares in India of, let's say, 10 lakhs, 15 lakhs, 20 lakhs, and you haven't filed your return of income, they can directly send you a notice stating that you have not filed your return of income and we are considering this 10, 12 lakhs as a income. Then they won't set off the purchases by themselves. You have to file a return even if you have made a loss. Then also it is advisable to file a return and clarify that we have understood that this is our turnover, but there is a loss also which we have incurred. So even in case of a loss, please file your return of income.
So at the same time, so people just see that their limit is okay, 4 lakh, 3 lakh, or 2.5, as the case may be. But incomes like capital gain or dividend are chargeable at a flat rate of tax. For NRI, there is no concept of getting the benefit of basic exemption limit. So if you have a flat tax, people at times also are of a notion that TDS has already been deducted on that, and we need not file for taxes. So paying TDS is a different thing. Filing of tax return is a different thing. The ultimate compliance that income tax department or government of India wants you to is file your income tax return, compute your total tax liability, declare your residential
Begin with.
status, declare what is your certain tax liability. So filing of income tax return is the important thing that people should not miss upon. Not be under a notion that TDS has already been paid and we are done with the liability part. So this is a very important point.
One thing
Yeah,
which I would like to emphasize regarding the loss returns is that the loss which you incur in Indian markets or whatever the reasons are, that is also included in your income tax return of the country where you're residing, and it is offset against your local income. So to have an evidence for that, that whatever loss you have claimed in your personal return in the country you are residing, you have additional document given by the government of India and the income tax acknowledgement or the 143 assessment order, whatever it may be, which is generally issued after filing the return. There are different types of orders which are passed. One is an intimation, one is an assessment order, but that acts as an additional evidence for claiming the loss, and it helps you in your local filing also. So, despite of having losses, we need to file our returns. That is a point which you want to raise.
yeah. So as I hear, I think there are excellent points, and more importantly, the bottom line is one should file return, even if they are a non-resident, and definitely recommended for many use cases like carrying forward loss or having an evidence of your filing or your income in India, and then using that maybe later on to take any advantage, or even if not advantage, but avoiding a notice. Um, and I think this is where I think NRIs need to kind of be more proactive. I feel, it often happens to me as well. Sometimes we may choose to ignore it, but it is not the right thing to do. And I think all we need is a good bridge here, so that NRIs have the right channel to do so. And I think that's where I think we are also helpful as a company. Yeah. So moving on, a new topic, TCS under LRS. I think this is, I know this is for residents, but I just want, the panel to kind of highlight on LRS a bit more, because a lot of NRIs believe that LRS is for them, or they have to, follow that. would be good to understand like how does this work and how does this affect NRIs particularly? If not,
No,
Yeah.
so
So Hemant, you
just
want to, so Abhishek, you want to take this or Naman?
No, no, you can take it.
Naman, you want to take it?
yeah, sure. So as far as the TCS goes, hello, am I audible?
yes, yes, we can hear you.
Yeah.
But
Yes,
your
Naman.
video is not.
Yeah, I think there is some technical error, but I'll just discuss on the TCS part.
Mhm.
So as far as the TCS goes, correct. So as Ajay rightly mentioned that many people think that this is for residents only, although they are correct, but still we need to understand that any non-resident who is outside India, they still have some of their relatives in India who are sending them money. Correct. There are many students who are going outside India for their studies or for starting their new job there. So still they are getting money from India, or many people get the investments for when they're moving to outside India, so that at that time they are residents. So this is pretty much relevant for non-residents as well, at least for the relatives who are here, or at least for when they're firstly moving to outside India. So now the limit, which was 7 lakh for LRS. So what is LRS? LRS is a liberalized remittance scheme, wherein what the government says is that for $250,000 you can take outside India, and no questions will be asked if it is for a particular reasons, which includes for your personal maintenance, for your investments outside India. So for all those reasons, if you are taking money outside India, so there is a FEMA regulation, Foreign Exchange Management Act, which says that till 2.5 lakh dollars you can take outside India, and no approval or no question is asked from the Indian government, because technically you are taking foreign exchanges from the Indian government and taking outside India, and all the foreign exchanges for the government is the property of the government and not the personal property of the residents of that country. So that's why they need to keep a track that how much foreign currency is going outside India. So the limit earlier for the LRS under for TCS was 7 lakhs. Now it has been increased to 10 lakhs. Correct. So earlier for most of the cases which is applicable is any other case here. So the TCS rate is 20 lakhs. Now people are confused that whether this 20%, sorry, 20%. So whether people are confused whether this 20% is my expense, so I have to pay additional 20% to the bank when I'm remitting the money outside India. So we need to understand that like the TDS which is being deducted and which you can claim while filing your return of income, TCS is also similarly you can claim, or the person for whom TCS has been collected by the bank, they can claim that TCS while filing the return of income in India. And if there is no taxable income in India, you can still claim a refund of this TCS while filing your return of income in India. So it is not an expense for you in India. It is very much refundable when you file your return of income. And the second amendment in this TCS point is that earlier there was a TCS, since many people send the education loan maybe for themselves or for their kids for higher education. So earlier there was a reduced rate of 0.5%. Now it has been completely removed. So there is no TCS if you send the loan money from a financial institution to any person outside India. So it is also a welcome change, and I think this will be a good boost for people who are investing maybe outside India or sending for their maintenance of their family members outside India.
So I would like to add an example here to what Naman has specifically mentioned the concept of TCS. So basically, if you want to move outside India 20 lakh rupees, you want to give it to someone who is already outside India. So to give 20 lakh, you should have a balance of 24 lakh available in your bank account. So 20 lakh goes to the person receiving the money, and 4 lakh goes to the government as an advance tax basically. So this is of course a kind of a cash flow which is stuck for a moment, but this is effectively adjusted to your net tax liability. And also, if you are paying a TCS amount, you can ask your employer in India not to deduct the TDS, and you can ask just share the TCS certificate with them. So your additional TDS would not be deducted. So it is adjusted against that. And also, if you are a businessman, or you are like paying advance tax, you have a liability to pay advance tax. The same is adjusted against that also. So it is vice versa basically. If you're paying TDS or advance tax, it is replaced with TCS then. And if of course if there is no tax liability, you file your tax return, entire money will be paid back to you by the government.
One thing which I just want to mention is that the whole idea of introduction of TCS by the government was to make people file their returns. This is a way where the government has a track of information that this person has sent this much money outside India, and that information is readily available with the income tax department. The information is always available within department, with the government, through RBI and through banks. But now income tax department also has become a party to those transactions, and that information is available to income tax department too. As Naman and Ajay has previously mentioned, with the growing technology and AI usage by the government, you get automatic notices. If your TCS has already been collected and you have not filed your return, you will get a notice that Mr. XYZ, you have sent this much money out of India and you have collected this much tax, but we have not received your return. Kindly file your return. So it's a way where the government has found out a way to make people file their return who are sending money abroad, and so that they can make ensure that they have legitimate sources for incurring those kind of expenses. Because if you are sending money abroad for maintenance of your family or your kids or study, then what is the source of those funds, whether they are legitimate or not? It is a way where government is trying to avoid money laundering and all those illegal activities which happen in international markets through transfer of money from one location to another. So it's a tool which is being used, and with the use of technology, they have been put to use in a quite effective manner, wherein notices have been received by clients, parents of the clients who have sent money to their kids' education. What is the source of that funds? And you have not filed the returns, or if you have filed the returns, your sources, your income is not commensurating the amount of fund you have transferred. So you need to be careful for that also. We can go ahead, Hemant.
Hemant, you're on mute.
Yeah. So coming to ULIP, so I see a quite an involved chart. Would love to have some examples. I think that would be more helpful. Like, maybe someone buys a ULIP, how does it, work out for them?
So this is a very good area where, in fact, the entire focus has been. First, let us see how does the concept of ULIP work. So basically, I will not go for in depth, but I will give you a few illustrations how this work. So what you have to see is for the ULIPs, that is unit linked insurance policies, if it was issued before 1st Feb 2021, and where your annual premium was less than 10% of the capital sum assured, whatever is the maturity pursued, it was exempt. And at the same time, what you have to see is for a ULIPs issued after 1st Feb 2021, where your aggregate premium is less than 250,000 INR and annual premium is less than 10% of the capital sum assured. In that scenario, it was exempt. Rest of the cases, it was taxable as per the slab rates. This is where the amendment has came in now. Instead of putting it into slab rates where your highest slab is at 30%, it has been brought down to capital gain, where long term capital gain is chargeable at a rate of 12.5%. This is the amendment number one. And the second amendment came in. So, of course, there is a lot of buzz around the Gift City now. Gift City is a IFSC, International Financial Service Center, set up in Gandhinagar, which is near Ahmedabad. And insurance companies or institutions based out of the IFSC, if they are coming up with such kind of products, so like ULIPs given by the IFSC or the insurance offices there, it would be completely exempt for the non-resident Indian. So this is the best part. This is a good motivation for the non-resident Indian to invest in India. So there is no income tax, there is no GST, there is no FEMA, repatriation is easy, dollar protection is there. So government is looking forward to give a lot of boost around the same. And similarly, there was an amendment for LIP also. Of course, there is no changes in the taxation, but again, life insurance policy also issued by the IFSCs or units in the gift city, it is exempt for non-resident Indian. So this is how the concept of taxation works now in India. So Naman or Abhishek, if you want to set up some example and elaborate it on further.
The chart is comprehensive enough. It's good enough. You have explained it. The idea is basically that the exemption is available when it's more beneficial for IFSC where you have the premium of more than 250,000 rupees. So if you are below 250,000, so then normally the policies are 10 times. Basically, you have to make sure one thing when you're making a ULIP that their sum assured is 10 times your premium. 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 10 If that is the 10 times the premium, nowhere, no matter where it is, whether it is in India or in IFSC, it is tax. It is exempt. Your proceeds are exempt. But if you are paying a premium of more than 250,000, or your sum assured is not 10 times their premium, then in those cases, it is better to take a policy from IFSC registered insurance company. All the companies are opening up their offices in IFSC, and they would be serving primarily to non-residents only, not to the local residents. So it's a good measure which has been taken by the government. But one thing is that this is exemption is only available in India. You have to check your local laws regarding the exemptions.
Yes, this amendment will any which ways be applicable from 1st April 2025. So from the next year, I think whichever policy will be or whichever taxability will arise, which will only be affected for 1st April. So it is advisable that you wait till 1st April 2025, let the final Finance Act come, and then maybe you can go on and start investing for this. It is basically like a investing in any mutual fund also. Similarly, they will take your money and invest in mutual funds in India. So it is technically similar to a market linked thing. So you can very well discuss with the investment advisors here, and if it is I think it will be beneficial because it's tax free. So you can try and invest in IFSC, because still IFSC is in a very growing stage. It is still not very much mature. It is still getting matured day by day. So let's see how these things pan out and how the insurance policies gets issued in IFSC.
Even we can go ahead.
So this is same about non-ULIP, life insurance policy, which I have already briefed. So here the limit is 5 lakh that you have to see. And of course, what is not exempt is chargeable at slab rates over here.
Okay. So yeah, that's all we have. But I'm sure you may have questions, so feel free to ask. You can use the Zoom chat and ask any related questions to the panel. And you can also reach out to us later at one of these coordinates, email, WhatsApp, Zoom call, or through our community. So I already see a question by Nick. Um,
Yeah.
anyone wants to answer?
Nick, as far as
Okay.
investments are concerned in Indian markets, they are governed by FEMA. Not they are governed by FEMA, but FATCA. But the restriction as far as taking investments from US and Canadian residents is a different perception. It is not related to FEMA. It's more related to FATCA. There are limited number of mutual funds and stockbrokers who are allowed to operate because it's their compliance in the local laws. The if any, let's say if Mr. X is a broker and he wants to sell products to a US resident or a Canadian resident, he has to comply with the local regulations of Canada as well as US. Most of the brokers who are not big enough, they don't comply with those provisions. Therefore, they are not allowed to take investments from the. So, but all the big mutual funds, whether it is HDFC, ICICI, Heyman knows all those, SBI, they are allowed to take mutual investments from Canadian and US residents. Similarly, insurance companies who would be selling ULIPs would have a similar kind of a situation where they will have to comply with the requirements in the local US and Canada regulations for taking investments from US and Canada residents. I hope I have answered your query.
So in Gift City, any which ways FEMA regulations are not applicable because it is deemed to be a foreign city as far as the Indian FEMA laws are concerned. But surely, as far as the financial institutions or the banks are concerned, they are still clearing out their doubts, and still they are in the way of making it a more smoother way of investment. But there are things to be get cleared, and as I mentioned earlier, it is still getting matured. So maybe that's why there's a confusion. Otherwise, I don't think there are any FEMA regulations which stop the foreign residents from investing in India, as far as IFSC is concerned.
Yeah, and I think Nick, you're probably referring to this restriction for Canadian residents. So we have recently launched Gift City funds in association with HDFC AMC, and as per them, they have not allowed Canadian residents to invest. But we are in the process to partner with more such AMCs or fund providers that will allow for Canadian residents to invest as well. So look forward to that. Maybe in a couple of months that we should have them as well on the NRI platform. And I think about the rumors, I'm probably not aware of it. I think the minimum limit still stands to be 150K USD. Yeah.
So this is
Uh,
basically company to company. HDFC has a
mm,
limit of 150,000. Nippon has a limit of 100,000. So this actually depends upon the the company making the product. So down the line,
mm,
when companies are coming in, there is a competition, more or less. The baby is grown up. You will see these limits coming down.
mm,
So it's too early
yeah.
still now for Gift City to see as a holistic picture.
Yeah. Yeah, and I think my perception so far has been Gift City is a new thing, and as anything new starts, it needs a bit more volume, and the volume can only come when there are high ticket sizes, and which kind of is more sometimes convenient, or allows institutions to start coming in with a big volume, and then as it becomes more readily available and mature, then retail money is also welcomed, and with obviously lower limits. Yeah. Okay. Any other question on the budget or separately? So
If
yeah,
anyone has
Viraj.
specific text queries, they can also ask, I believe.
Yeah. So Viraj,
Hi,
please.
hi, this is Viraj, resident in Canada. So I have a question about tax. I do not have any income in India as such. I had like a NRO account since maybe last 6, 7 years, and recently I just opened my NRE account. So what I have done so far is just transfer money from abroad to India in my account, and I think I never filed any taxes so far. So I do have to file taxes even though I don't have any income in India. I did some fixed deposit in NRO, but very marginal. Like the interest was 10,000 or less. So do I have to file tax every year or return whatever?
So
Naman, you want to take?
yeah, so just a small question that any specific reasons, since you're saying that I'm sending money from outside India, any specific reason for NRO deposit? Why are not going for NRE deposit? That's a tax-free deposit for you in India.
Yeah, true. So I didn't know that. So recently only I opened NRE account. So now onwards I can do it through NRE only.
Okay. So
Yeah.
glad that you brought this question, because recently also we are dealing with one of such assessments from the income tax department, wherein the question that has been raised from India is that what is the source of the investment, or what is the source of this FD that you have made in India? Correct. So
Yeah.
whenever you make an investment in India, it is advisable to always file your return in India, even if it's for a very small amount. Because let's say, for example, you are saying that I'm earning only 10,000, 15,000 of interest in India. That must be
Hmm.
attracting a 3,000 or 4,000 of TDS. Correct. First of all, that
Yeah.
TDS, you can get a refund of that TDS, that 3, 4,000, whatever TDS is getting deducted. Number two, while filing your return of income, you are getting tax compliant. And in future, if any tax return is required for any of your requirements in India or abroad, it is helpful for you to have those records available handy with you. So in addition to that, just a quick checklist for all those non-residents who are sitting here. Whenever the financial year ends, which is right now, March is getting ended, it is advisable to have 4 5 quick documents available with you whenever you close a financial year in India. Because in if in future you get any query from the income tax, you readily have those available. So one would be taking out all your NRE, NRO interest certificates from the banks. Correct. Having all
Hmm.
the funds investment source available with you, readily available, that how did you invest those funds in India, from where did you get those funds. Number three would be getting your passports and number of days in India that you stayed in India readily available in an Excel. and number 4 would be filing your return of income in India. So if you have these 4 things readily available, if you are just investing in the deposits, this will be very handy for you, and you will have a easy life when you move forward. Because going through
Okay.
this AI, many of those people get information, they get notices even for a small amount. So it is advisable that when you are doing any investment, always keep all these documents handy from the banks, as well as for your personal safety in future.
Okay, thank you. Yeah.
And whereas government of India is not charging you anything to file income tax return in India, so there is no
Correct.
cost to file ITR. At eventually no cost, you get a refund of whatever the TDS has been deducted, since your income is below the exemption limit. So there is no harm in having one document which says you are a tax compliant citizen of the country. So of course, if you're there in US, Canada, you are filing your ITR over there for your foreign income. But it is always good to have a document in India which substantiates your residential status to the government, that okay, you are an NRI living in so and so country, and also at the same time what sources of income you have.
Okay, sure. Yeah, I'll do that now onwards.
Yeah. So Ajay, I have one question. Praveen here.
Yeah, Praveen.
Yeah. So Ajay, so when it comes to the FCNR deposits, these are like tax free, right? The
If
income
you are a
interest from
non-resident
this.
Indian, FCNR, yeah, interest on FCNR and NRI deposit is exempt if you continue to be a non-resident Indian.
Got it. So will this be considered as an income? Will I have to show this as an income in my returns or how?
So this is an optional thing. In case you want, you can add it as an exempt income. But primarily, government says we don't want this information. You need to declare only the income which is taxable in India in the Indian income tax return. So this is considered as good as a foreign income for you.
Foreign income. Okay, got it. So this will not see, there is one clause in Income Tax Act, like if your income crosses 15 lakhs or more, you'll become a resident, no? So in that, it'll
In
not be
that,
added,
no, no,
right?
no. So 15 lakh, you see only the taxable Indian income. You don't see NRE
Taxable.
deposits, you don't see FCNR, you don't see
Okay.
your foreign salary. Only the
Okay.
income on which you have to pay tax in India is seen for the purpose of calculation of 15 lakhs.
Got it. Fine. And I also have another question for you. See, I live outside India more than 200 days. But I live majority of my days in Dubai, like 183 days in Dubai. I'm a tax resident of Dubai, like I get TRC and all. But moving forward, I might be traveling a lot in other countries as well. So in this case, I might not be able to like live 183 days in Dubai. So will it be a concern for me like to show my tax residency to India?
So for India, you would be a non-resident Indian. So if you
Okay,
are
got
living
it. So
outside
that's all
India
for
for
India, right?
183 days for a
Ajay,
bona fide,
I just want to make to highlight that this, if he's an Indian citizen and he is not a tax resident of any other country, then he's deemed as a tax resident of India as per the latest amendments, which were made in 2024 itself.
no,
If
no. So
he
if he is traveling outside Dubai and outside India for work purpose,
if he is not a tax resident of any other country in the world, he has to be a tax resident of any country other than any other world. If he is a citizen of India and he is not a tax resident in any other country of the world, then he is deemed as a tax resident of India. This is the amendment which came in 2023. So you
But
just
that will
make
be
sure.
applicable only if he has Indian income of 15 lakhs or more. I believe that
If he is a
correct.
citizen, if it is a citizen, then yes.
Yeah.
Just
So
check the
then
provision.
this is
You
the
have to be careful
confusion
for
like
that.
what?
This you have to be
Yeah.
careful for that. If you are
Yeah.
a citizen of India and you are not a tax resident of any other country in the world, then you have to check the provisions specifically whether you are deemed as a tax resident of India. Earlier, there used to be no confusion. If you are outside India for 183 days, you are outside India for more than 60 days, and without any reasons or whatever the reason for work purpose and all those, then you can be deemed as a non-resident of India. But now, for citizens of India, specifically for citizens of India, there was an amendment made. You just need to check the income and all those other criteria also.
Okay, so that whom should I get in touch with? Like any of you?
It all depends. You can get in touch with any of us. You have to share your further details. I just wanted to make it that you cannot simply say that you are outside India for more than 183 days if you're a citizen of India. So there has
So I'm a citizen of India, and I have like companies in multiple countries, like in Canada and US. I've started, and in Dubai as well. So henceforth, like I'll be traveling a lot in these countries to pick up business. So that's the agenda. Right now, I'm living in Dubai, but moving forward, I might not be able to like spend. I might or I might not. So what is my scenario? That's what I just wanted to understand.
What is your total income in India?
In India, my income is not more than 5 lakhs, 5 to 10 lakhs.
So then that doesn't make a
Not
difference.
applicable.
Then you would not be applicable. That won't be a concern.
So if
But
I cross 15 lakh, then I come to the different category, right?
yeah,
Whatever you told, the deemed income.
yes, you need not deemed income, deemed tax resident of
Citizen.
India. Yeah,
Okay, got it.
you just
Okay.
check that provisions and check the
Hmm.
number of days, because there is a limit of 120 days also
Okay,
in
got
case,
it.
because the provisions of
Only if my
residency.
income crosses like 15 lakh above in India, right?
Yeah, for citizens
Okay.
and persons of Indian origin, there is a limit of
Okay.
120 days also. So it's
Okay.
altogether a different topic to discuss regarding the agency. So
Okay.
it's not a blanket yes or no kind of a situation. You have to give more details, and then we can determine those things.
Got it. Yeah. Okay. Thank you.
Yeah.
And I'll get in touch with any of you
Yeah,
like for
sure.
further. Yeah.
Okay.
Uh,
Any more questions? We're almost at 1 hour mark now. So good time to ask before we close.
Just a quick question. I'm kind of debating between and trying to understand why invest, pros and cons of investing through an NRI account versus Gift City. Like, why would someone choose one over the other?
No, so option what you're seeing is Gift City and NRE is a different thing. NRE is your bank account. Gift City is a specific financial center where you are investing the money. The investments in Gift City would be in the dollar terms, first of all. And you can put in the money directly from your US bank account also there, or your foreign bank account. So when the money comes to your NRE account, it is converted into INR. The advantage would be directly doing is you are safeguarded for the forex conversions. The money that you lose on the conversion of the forex from like dollar to INR, you would be saved from that part. So that is the primary difference.
Okay, from dollar to INR and then again INR to back to dollar.
Again, while you bring back the money, again you will have to spend on the forex.
Okay,
So the
so
money
other
sending and receiving, you are saving on that part.
because other than that, it's both of them are tax free, right? Through NRE or through Gift City in India.
Nick, I
Both
just
are
want to
tax free.
highlight your risk is not for the only foreign exchange. When you invest into a mutual fund, the investment will again get converted into INR. It is for you in dollar terms. For the fund, it is going to be INR. So far, Gift City has not come out with dollar-denominated funds.
Yeah, I know they invested into
Soon
feeder
they will
funds.
come. Soon they will come. They are purely feeder funds. Right now, it doesn't make sense for a resident or retail investor to invest through IFSC. IFSC is primarily for those FIIs who were investing into Indian markets from various locations, Mauritius, Cyprus, and all those locations where are tax-free nations, where does not these mutual fund derivative incomes and investments are not taxed. So government of India gave them a center within India so that the money does not go out of India actually. Gift City is part of India per se. What used to happen if somebody, like in case of Vodafone was controlled by a Mauritius entity. The money flowed between Mauritius and London. Nothing came to India, but there is a huge tax debate, huge issue for that. They created this Gift City so that the money remains in India. The foreign exchange doesn't go out of India. Right now, for retailers, it is not advisable to go through Gift Cities unless and until you are investing good, handsome sum of money, because you still carry that risk of currency conversion. Like the way dollar has been behaving, if somebody has invested 1 year ago, in despite of having 10% return, he must have lost 10% right now, because the dollar has risen by from 82, 83 to 87, 88
Yeah,
levels.
correct.
So there is no sense for a retail investor to go through a Gift City. It's better to do it normal route, and soon probably the Gift City may come out with dollar denominated funds, then they may be helpful. ULIPs, as Naman has already mentioned, April onwards, probably the mutual fund units start taking the. But all those, if they are rupee denominated, then foreign currency hedge is not there.
Makes sense. Okay. Thank you, Abhishek, for the to the point answer.
Gives
This is very
gives
helpful.
Gift City has FCNR deposits which are having higher rates. Indian banks having Gift City offices are offering higher rates on FCNR deposits. Go for those investments rather than going for mutual funds and ULIPs at the present time, because they are purely feeder funds. They get their money converted into rupee terms, then they get invested. So you're having that risk of foreign currency.
And the reason I ask you this question is I'm located in Canada as well. The reason I ask you this question is because we both know India ETFs in Canada, there are only two, and they have ridiculous amount of MER
Yeah,
associated with them. One is the BMO, there's another one.
yeah.
So I want to invest in India, and the conversion rate of 87. Well, with Canadian dollar, it's still 60, but my income from US as a consultant, it's very tempting to convert $1 to 87 Indian and invest it in India right now. With
Yeah, it's very lucrative. Go NRI as a platform. Do it through them. That's the
exactly.
best way, because it's more transparent. What's happening in Gift City, nobody knows it. People there out are not confirmed what is happening out there, because they are purely feeder funds. They are just feeder funds. They are
Yeah,
feeding the SDFC mutual funds having office in Bombay. So it's not make sense. It's better to go with iNRI. You have a person to contact to who will get you the information whatever you want. And
thank you.
the best part is the returns. I am telling you from my experience, I have done calculations for clients who have made more than 15% returns despite of the currency fluctuation and taxation benefit loss. Those who have been investing regularly in Indian markets, they make the kind of returns Indian markets is given in last 5 years. It has been phenomenal. There is no other country in the world which has given that kind of returns. So, in spite of calculating the currency loss and the tax, the client had made more than 15% return. So, I cannot say that this will be repeated in future, but yes, it makes sense. If rupee becomes strong, today you are getting the money invested at 87, and tomorrow rupee goes to 85, then you already make 5% already out of it.
Makes sense. Thank you, Abhishek, for
Yeah,
to the point answer.
yeah,
Appreciate that.
yeah.
Okay, cool. Thank you all. So last chance, I think 1 minute to go. If any last question we can answer. Okay. So thank you all.
So let the income tax bill come in.
Yeah,
Probably, if there are good things coming around, we will see you again.
yeah. Could you share more
But
about Ajay? Just 1 minute on that. Like, what is this bill? How
so
what is
chances
important?
are very less,
Hmm.
taxation structure is not going to change. So in fact, couple of hours before I was meeting Piyush Goyal, he was at in
Hmm.
my city, and while interacting with him, he also said that nothing major changes are happening around the taxation structure. More or less,
Hmm.
I think language would be changed, and government will be very slow in changing the entire structure of the taxation. This is
Hmm.
a very comprehensive law. Income tax law today is of 1961, and we are in 25. So almost six and a half
Hmm.
decades old law. Nothing is going to be changed overnight. So this would be a very slow and gradual process. What they are trying to do is just simplify the language so that it is easy to understand, easy to implement, easy to regulate. That's it.
Hmm. Got it.
Hemant, one thing
Great.
which I can add about the new income tax bill which is going to be there, this bill has been in making for last so many years. I have been one of the committee members who were drafting this bill before coming to Canada. I was part of that committee. I had given my inputs in those drafting of those bills. I don't know what is the exact position right now, but since I moved out of Canada, it was not ethical on my part to continue with those positions. So I moved out and left those positions. The law is primarily going to be the same. It's not going to be right now in income tax have we had in last 60 years from 1961 to 65 we had so many disputes, many things have changed, many
Hmm.
laws have settled and all those. So they are just giving away all those things, and what is the settled proposition of law that is being put in the form of new direct tax code. which is also in lines with other countries' laws, like what we have in US and what we have in Canada. Like if you, I have been part of that GST also. I did that lot of drafting for GST also. If you compare the GST law of India and compare the GST of law of Canada, you won't file a full stop comma difference in many of the places. The
Mm,
principle and the concept has been adopted because understand the ideology behind. India was a British colony, Canada is a British colony. They, everything comes from the British. The roots are British. So they follow that whole principle which is going there. So it's everything going to be same, nothing going to be changed. There may be some nuances. One which of the main concern areas, probably for those who are planning to go back to India, there is a possibility that RONR status may go away, which many US people who are planning to go back to India, they want to have the benefit of RONR for the next 3 years, which may not be available if the new direct tax code, if the way it is being rumored and said. If RONR status goes away, then it becomes a quite a challenge for those who are planning to move to India. That can be an implication for NRIs with the new direct tax code. It's just a rumor, it's not a confirmed news, but still, yes. There was a query yesterday also, probably somebody was asking about what will happen to the direct tax or new NRR status with the new direct tax code. So this is a huge rumor which is going on, and it has a big implications for those who are moving from India, from abroad to India, back to India.
mm. So Nick is requesting a session, I think, on exit. I'm sure like this, many people would be interested on how to move back to India. So yeah, we'll plan for something later in the future. Great. So I think thank you all. This was a great session. I personally got to know of a lot of these NRI stuff, particularly related to India tax. Bottom line, obviously, I would want to say that please file your taxes in India, whether especially if you have some income, even if it is non-taxable, it is make best to do it. Good for in India and also you know, kind of providing that as an evidence in your residence country if you need any tax credit, or even if not, you know, you're able to kind of provide a trail of financial evidence.
Hemant, one thing which I want to at last
Mm,
add while filing taxes, since you are mentioning, one
mm,
thing, once your income crosses a particular level, let's say your crosses 25 lakh rupees, you are not going to tax at 30% in India. NRIs are not going to be taxed at 30% on their interest income, on their dividend income, on their capital gains. Every country has a treaty with India, and if you're a tax resident of some other country, the rate of tax is reduced. In case of American, it is 15% on interest, it is not 30%. Whatever interest you earn, it is taxable at 15%, provided you prove that you are tax resident of the USA to the Indian government. There's a
mm,
treaty in place which says that maximum tax can be only 15%. Similarly,
mm,
for dividends, capital gains is already restricted to 12.5%. So it's not 30% in every case. 30% may be there for rental income, but I don't think so that many investors or who are people who are attending these webinars having rental income exceeding 25 lakh rupees in rental income. If they are having, yes, it is 30%. And effectively, it is not 30%, it is 21% because you get a 30% standard deduction in India.
mm,
So you have to take benefit of your double taxation avoidance agreement with India and the other countries. For proving that, you have to file the return. That's more important. And there are law procedures to follow those, which you have to do it all the year round. When you start investing, the moment you start investing, you have to follow a procedure. You have to file Form 10F with the respective person that I am a resident of XYZ this country. This is my tax agency certificate. Kindly deduct my TDS at a lower rate of 15% because I am taxable only at 15%. Otherwise, they are going to deduct TDS at 30%. So this is what you have to take care every year, and that is why what is the importance of filing the returns. And with this, I guess I can to an end. Can go ahead and you can conclude the meeting. Or,
mm. Yeah.
yeah.
Thank you, Abhishek. I think a lot to learn. Obviously, you've seen many years of India taxation and then obviously the NRI stuff. So
Yeah.
good to hear like practical points and guidelines specifically for NRIs. Um, Great. Thank you, Abhishek. Thank you, Ajay, and thank you, Naman. I know you guys are joining from India, must be very late. So thank you for staying this late for our audience and sharing valuable insights as always.
Yeah. Okay.
Pleasure.
Always,
Bye.
always
Take,
a pleasure.
it,
Yes,
bye.
yes.
Take care.
Okay.
Thank you. Thank you. Bye.
Thank you. Bye bye.
Thank you, everyone. Have a good weekend.